Paychex Incorporated is a leading provider of integrated human capital management solutions for payroll, benefits, human resources, and insurance services. Paychex empowers small and medium-sized business owners to focus on the growth and management of their business. Learn more by visiting www.paychex, that's Paychex.com, and stay connected on Twitter and LinkedIn. Earn a Master of Professional Accountancy from St. Joseph's University and build the skills to prepare yourself for the CPA exam. Our 30-credit MPA degree can be completed fully online or on campus in Philadelphia. Visit sju.edu/PICPA. Hello, I'm Bill Hayes, Managing Editor of the Pennsylvania CPA Journal. Welcome to CPA Conversations, PICPA's podcast series where we'll talk to CPAs and other professionals about pressing matters affecting the accounting industry. In a preview of his presentation at the July 12th and 13th PICPA Not-for-Profit and Government Accounting Conference, our guest today, Rick Cole, partner with BKD CPAs and Advisors, joins us to discuss the new ASU related to gifts-in-kind non-financial assets, including how contributed non-financial assets are presented on financial statements and when the rules brought about by the new ASU will go into effect. Rick, thanks for being here with us today.
It's great to be here.
So I guess for a bit of context here before we dive into some particular type questions, why did the FASB, the FASB, why did they come out with this new standard on gifts in kind?
That's a great question. I like getting into the whys. Having worked at the FASB for 6 years, I really learned to appreciate the drivers behind the issuance of the standards. And this was a standard. The project started when I was still working there. And I worked on it for about 6 months or so, right before I left the firm left the FASB to join BKD. And the FASB had heard that some regulators around the country had some concerns with the fair value that was being recorded by nonprofits whenever they receive, or not whenever, but when they received certain types of gifts in kind.
Yeah.
And the issue was that there were some types of gifts in kind that may have had some restrictions, that they might not be able to be used in certain locations around the world. And as such, there was some concern that possibly the fair value should have been adjusted because of these donor restrictions. So the FASB ended up taking on this project where they just started looking at the contributions of non-financial assets. And when I say contributions of non-financial assets, a non-financial asset is something that is other than cash or something that can be readily converted to cash. So these gifts in kind of non-financial assets would be things like pharmaceuticals, medical supplies, clothing, food, and things like that, not cash, not marketable securities. And the FASB undertook a project to try to decide if something should be done about the accounting and the presentation and disclosure. And ultimately what they decided was that they did not want to get into changing the accounting, the fair value for these types of gifts that were received, because you don't want to have a different GAAP for different industries. You want GAAP to be the same across all industries where all possible. So instead, what they decided to do was to focus on presentation and disclosure and making sure that there was appropriate transparency in financial reporting for these types of gifts, these non-financial asset gifts that were received by nonprofits. And by getting into appropriate transparency, with the presentation, as well as adding to the disclosures, they thought that would improve the usefulness by financial statement users. So it's really interesting when you think as to the why, and then once we get into understanding what the new requirements are, I think most people will see that the transparency has definitely been escalated.
How are contributed non-financial assets presented on a statement of activities today? I mean, if at all, really. But how are they presented?
So, if at all is actually a good part of it. So certain things are not meeting the definition of something to be recorded, so those wouldn't be presented at all. But those that do meet the definition to be presented, there's diversity in practice. One could argue conceptually that the requirement today would be because it's a discrete category, it should have its own presentation if it's material. However, I think that many people, if it's not ultra material, will combine these gifts with other types of contributions. So often organizations will combine on one line item contributions of cash, as well as contributions that are due to be received in the future of cash, as well as contributions of these non-financial assets. And they might not have any disaggregation at all in the financial statements. Other nonprofits do disaggregate and might show it separately.
Yeah.
But there's often not an enormous amount of disclosures surrounding that. Again, it depends on the materiality. So there is diversity, and as we get into the changes, it creates more consistency, and it definitely enhances the disclosures.
What are the presentation requirements on the statement of activities once the new standard is implemented?
Yeah, so it's actually a very simple it's a simple requirement, and basically the non-financial assets have to be presented as a separate line item in the statement of activities. And it's just the revenue that we're talking about, not the expense. So on the statement of activities, you don't need to present the expense, only the revenues.
Yeah.
So you can go about this in two ways. In your revenue section, where you have your contributions, you could have a second line right below that or right above it, depending on where you want to place it. And you have flexibility of where you present it, but most people would put it right above or below your other contributions received of cash. And you could just have a separate row, and that could be contributions of non-financial assets. You could also instead have a column instead of a row. So if you can imagine a statement of activities, normally along the left side, you're going to have all these line items, whether it be revenues and whether it be contributions and grants, whether it be investment income. So you could have it like that. But you could also have a column, and normally you might just have three columns: one for without donor restrictions, one for with donor restrictions, and one for the total of those two different restricted or unrestricted categories.
Yeah.
So you could have a column, and within that column, you could break out as a separate column your gifts of non-financial assets. Now, what's interesting is if you do that, you should also show the expense as well. Because if you think about a statement of activities, you got revenues and expenses. So you're going to have a revenue without any expenses. Yeah. And again, there's no requirement to show the non-financial assets that were expensed. There is no requirement. But if you're going to do a column, I do think it is probably better practice to also show the expense, because otherwise that column is going to be a little awkward, where you're going to just have that revenue go all the way down to the bottom line without the asset being the gift being relieved when it got used up. So those are the two choices you have. You could either do it in a column or you could do it in a row.
Okay. Now, under the accounting standards update, what are the required disclosures for each category of contributed non-financial assets?
Yeah, so I think this is really something that's been enhanced. So obviously, we just spoke about the statement of activities presentation. So now it's kind of there and everyone can see it. And I should have pointed out, obviously, this stuff really only matters if it's material. If it's something that's immaterial, then it's probably something you don't need to worry about. So focus on materiality, and of course, speak to your auditors if they agree with your materiality threshold. But the disclosure requirements would be to disclose a disaggregation by the category of non-financial asset, including whether it was used or monetized, and I'm going to explain this.
Yeah.
And then if it's used, where it was used, which programs, and also what are your policies on monetization of these types of gifts. So I just want to break that down a little bit. When you disclose disaggregation by category, so one example might be food as a category, one might be clothing. I would say that you don't need to, if you get clothing, you don't need to break it down between shirts and pants or men's and women's. If you get food, you don't need to break it down between vegetables and meat. So I would say broad category. There's no definition within the codification as to what that means. So I like to explain that it's not meant to be a giant laundry list, but just kind of broad categories.
Yeah.
And the concept of whether it was used or monetized, often donors might give gifts, and the intent is for the nonprofit to sell it and then use the proceeds for something. Or they might get gifts or donations, and the intent is for them to use those items during their programmatic activities. So whether or not the not-for-profit monetized it or if it used it within programs, that's another required disclosure. And then, of course, if you are monetizing, what is your policy on monetizing? And that's another important disclosure.
Yeah.
There's a requirement to also disclose a description of any donor restrictions associated with a non-financial asset. And this is something to, again, address some of the regulated concerns that were raised, where you might get a gift and you're valuing it using pricing that might be in the United States, but you might have a restriction that says that you can't use it in the United States, but that's a donor restriction, not a legal restriction, so that won't go into the pricing. So by having a disclosure requirement that describes any donor restrictions, it makes the financial statement user kind of aware what the limitations were on the use of that gift.
Yeah.
And then when you think about what the next requirement is, and that's to provide a description of the valuation techniques and inputs used to arrive at the fair value measure for the contributed non-financial assets. That, again, allows the financial statement user to understand what did you as a nonprofit consider when you were coming up with the fair value. And what you considered would be obviously looking at the principal market or the most advantageous market, which are technical terms. And that's what you should be looking at. And sometimes restrictions from donors may prevent you from using those assets in those markets. So you kind of have that conflict there of, well, the donor says you can't use it here, but that's the market that you are using for pricing.
Yeah.
So having the disclosures, those two disclosures, lets the financial statement user understand those two concepts. So at least they have the information that they can understand while they're analyzing a set of financial statements. And then the last requirement is to disclose the principal market or the most advantageous market used to arrive at the fair value. And again, when you have that disclosure and then you see what the donor restrictions are, and then you look at the valuation techniques, having all that information, again, just keeps adding clarity to the financial statement user as they're trying to understand why did you come up with this valuation that you did, and they can at least understand any limitations on that.
Yeah.
So those are all the disclosure requirements and the presentation requirements, and you can see there's a lot more there. I don't think anything is a heavy lift to do, but it just gets information into the financial statement so the financial statement user will have that. And I think that this really goes a decent ways against or towards addressing some of the concerns that the regulators were raising, and at least it will make users kind of aware of things that were concerns that the regulators raised.
Okay, now as far as timing on this ASU, when will it go into effect, and is there an early adoption period permitted?
Yes, often there is early adoption, and there is here. It is permitted. You are permitted to early adopt, and it's effective for years beginning after June 15th of 2021. So it's really the June 15th of 2021 has just passed. So that means that for fiscal years beginning July 1st, which will be fiscal years ending on June 30th of 2022. So June 30, 22 year ends will be the first group of people that are required to implement this. But you can early adopt. So those that are closing books for, let's say, this past March or December even, they could adopt it early if they choose to.
Well, excellent. Rick, thanks for being here with us today and sharing this important information with our audience, and certainly good luck at the July 12th and 13th PICPA Not-for-Profit and Government Accounting Conference. I'm sure the attendees are in for an informative presentation here, so if people would like to learn more about attending the conference, make sure to check it out at www.picpa.org/conferences. You'll see it right there. But again, Rick, just thanks so much for joining us today.
Thank you.
As usual, we want to remind you that we have an extensive library of CPA conversations. Check them out at www.picpa.org/conversations, or make it easy on yourself by subscribing wherever you get podcasts. And of course, make sure to pass along your ideas for podcasts to content@picpa.org. One more thing, if you enjoyed this podcast, make sure to rate us so other CPAs can find us. Talk to you later, everybody.